Gentlemen, good day and welcome to the 5-Star Business Finance Q2FY26 earnings conference call hosted by DAM Capital Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on a touch-tone phone. Please note, this conference is being recorded. I now hand over the conference to Mr. Sanket Chheda. Thank you and over to you, sir.
Yeah, thanks. Hi, and very good evening to all of you. We have with us the management of 5-Star to discuss their Q2 results and outlook thereafter. We have with us Mr. Lakshmipathy Dindayal, who is the Chairman and Managing Director, and Mr. Shrikant Gopalakrishnan, who is Joint MD and CFO. Without further ado, I'll hand the call over to Mr. Lakshmipathy for their opening remarks, and then maybe we'll follow up by question and answers. So over to you, sir, Lakshmi sir and Shrikant sir.
Yeah, thank you, Sanket. Good evening. We welcome all to the Q2 earnings call. As we have updated in the last quarter, we have given a stable performance in the current quarter across various metrics. The downtrend that we witnessed in Q1 has been arrested in the current quarter. And from here onwards, we believe that we would see some green shoots emerging in Q3 and a much stronger performance in Q4. We have taken several strategies and actions towards this across sourcing, credit underwriting, collections, and risk oversight. These are marked out as focus areas for us in the quarters to come. And we believe this will pave the way for building a bigger and stronger portfolio in coming quarters. While our asset quality and credit cost have seen marginal impact in the current quarter as compared to the previous quarter, these still stack up better than many of our peers operating in the small ticket secured and unsecured loan space. As I had said in the past also, we believe that a trend reversal is likely on the horizon and is expected to play out over the next couple of quarters. Our investment in physical infrastructure and people continues, as can be seen from the addition of 33 branches and 769 business and collection officers during Q2. During this quarter, we disbursed rupees 1,196 crores of loans as against rupees 1,290 crores in Q1. And the drop in disbursement can be attributed to the additional controls that have been implemented for the first time during this quarter towards onboarding the right customers. With our system getting attuned to these changes, we should start seeing increase in disbursements and increased AUM growth in quarters to come. Our collections from unique customers and overall collections have remained stable compared to the previous quarter. Collections from unique customers stood at 95.1%, the same as last quarter, and we have seen an improvement in the overall collection efficiency, which went up from 96.3% in Q1 to 96.7% in Q2. These metrics shows early signs of revival, though in a gradual manner. During this quarter, we availed incremental debt of rupees 1,068 crores, and the cost of incremental debt came in at 8.56%, which is marginally lower than the cost of incremental debt borrowed during previous quarter. Cost of the funds on the book has dropped by about 27 bps. And given our cost of incremental debt, we should see improvement in the cost of funds for the full year. With incremental yields on assets coming in lower than the book yields, since we are lower our yields in last November, we expect to bridge a good portion of the yields drop through drop in cost of funds. We continue to have a robust liquidity on the balance sheet of rupees 2,360 crores. For the quarter, we achieved a PAT of 286 crores, 7% higher as compared to the previous quarter. Even during these extremely challenging times, we have been able to achieve healthy return ratios, as can be evidenced in the increase in return on assets from 7.24% in Q1 to 7.49% in current quarter. An increase in return on equity from 16.57% in previous quarter to 16.91% in the current quarter. I'm also happy to inform all of you that we have commenced our housing loan product during this month. The first few logins have come in and in various stages of processing. While this may not have a significant impact on growth for this financial year, this would be a lever of growth for the coming years. We expect to deliver on the guidance for this financial year that we have given you and look forward to the much better and stronger second half of this financial year. Now, let me invite Srikanth to take you through more on other numbers.
Good evening to all of you. After a difficult quarter in Q1, when we had met you all post our Q1 results, we had very clearly guided that we expect the second quarter to be a quarter of stabilization. And as we speak, we stand vindicated in our belief. The second quarter has been a stable quarter across various metrics, as Mr. Pati has pointed out. He has touched upon many of the operational metrics. Let me quickly delve into a few of the financial metrics and then open out for any questions that any of you may have. Our yields continue to be around 23.2%. We have had a good drop in the cost of funds, which has come down to about 9.27%. So the spreads have fairly remained constant on a sequential basis at around 13.9%. The NIM again has been consistent on a sequential basis, but obviously NIMs have an impact of leverage getting built up, so it will continue to drop as we go forward and have a good portfolio growth. Our cost to income ex credit cost is largely stable at around 31%. The credit cost guidance that we revised last quarter, we have been able to maintain the credit cost at around 1.34%, which is very marginally higher than what we had in Q1. So even across asset quality, collections efficiencies, and in the credit cost, we have remained stable. This has resulted in an attractive ROA of close to 7.5% and an ROE close to 17%, which are very good numbers given the trying times that we are all in. From a debt perspective, lenders continue to see us as a very strong borrower. So we did avail more than 1,000 crores during this quarter. And during the quarter, we also onboarded JP Morgan, one of the largest banks in the world. And this was for a very sizable investment into our PTCs of close to about 650 crores, about $75 million, and at fairly attractive rates. So not just any lenders, but even pedigreed lenders are looking at Five Star as an attractive destination to lend their monies to. So we should be able to build on this foundation, and which will also aid in our asset growth in the quarters to come. Our collection efficiencies have been largely stable. Unique collection efficiency stood at 95.1, and we saw an improvement in the overall collection efficiency by about 40 basis points. We believe we should see improvements coming in Q3 and hopefully a much stronger quarter in Q4. On the provision coverage ratio, we continue to hold close to 1.9% of provisions on the overall book. While our PCR on the stage 3 assets dropped a little bit, this is purely on account of the write-offs that we have taken. So if you would understand, whenever we take a write-off, these are typically deep delinquent assets on which we carry a much larger provision. So there will be a drop in the provision coverage, but we are still having a very healthy provision coverage on stage 3 at over 45%. And when you compare this with peers in the industry, this still stacks up as one of the high numbers. On the profitability side, we had a good quarter. So our profits grew 7% year-on-year, and on a sequential basis, we clocked a profit of about 286 crores during this quarter, and which resulted in a net worth of about 6,800 plus crores as of September 30th. So on various metrics, this has been a calm and a stable quarter. Our belief is that we should start seeing improvements coming through in Q3, which will pave the way for a stronger Q4 and thereafter. With these opening remarks, we are happy to take any questions that any of you. Over to all of you for any questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Renish from ICICI. Please go ahead.
Yeah, hi sir. Am I audible?
Yeah. Yes, Renish.
Yeah. So sir, 2-3 questions from my side. So one on this early bucket pool, right? So 30 plus has again gone up to sort of more than 12%, this highest since COVID. So how do you see the early bucket moving going ahead? I mean, obviously you did mention about tightening credit filters, etc. But do you see any green shoots in October or I mean, any early sign of early bucket pool softening down going ahead?
Renish, our thought process is going forward, at least for the next 3 to 6 months, we don't want any buckets to bulge up. So we want to bring in a stable performance across all buckets. So that's our prime focus. If you see unique customers at 95.1%, that means there will be some slipperages from current to arrears. So that is inevitable. Right. We are trying to arrest that in this quarter. Hopefully, I'm seeing this quarter the focus will be more on current customers, not much slipperages from current customers. Eventually, this 30 bucket will start stabilizing and coming down.
Okay, I mean, so basically what you're trying to say is the current focus is containing flow forwards in the already delinquent pool, and the early bucket pool, might start improving after a couple of quarters. Is that what you are trying to highlight?
From this quarter onwards is what I'm trying to say. What you said is right, from this quarter onwards.
Okay. And sir, my second question is around this, disbursement run rate, right? I mean, last year or so, we have added almost 140 branches, added more than 2,500 people. But disbursement has been, little curtailed. I understand that we have been very guarded when it comes to sourcing new customers, etc. But when do you see the disbursement run rate, start picking up meaningfully? I mean, when do you see the infrastructure which we added in last year or so start generating business?
See, as I said in my opening remarks, we have brought in the underwriting tightness and risk oversights, but by creating layers before a file even gets into the login stage. So this kind of controls is very new for our system. We have done it in last quarter. So close to 5,000 officers are there, close to 1,000 BMs are there. To get attuned to this new system, it will take some time. So that is why we said in Q3, you will see a better performance and a very stronger performance in Q4.
Okay. So basically, this quarter, most of the operating parameters are sort of bottom out. I mean, disbursement as well as the sort of credit cost has picked out. Is that the fair assumption?
Yes, that's our belief.
Okay. I do have a few more, but maybe I will come back in the queue. Thank you very much and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Viral Shah from IIFL Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity, and I would say congratulations on a good set of numbers. Mr. Pati, if you can elaborate on two things. One is the changes that you have highlighted and mentioned also in the press release with regards to, say, the sourcing, underwriting. If you can just elaborate and try to give us a flavor of what are the things that you have changed. And consequently, because of that, do you think, how much time do you think we will take to go back to, say, a 1,400 crores kind of a quarterly disbursement run rate? That is my first question. And the second is on the asset quality front. While I look at the unique collection efficiency remaining stable QOQ, but the overall collection efficiency has started improving. So, and this has been actually accompanied by your net slippages improving both on stage 2 and 3. First of all, do you see now the recovery starting to come back even from delinquent customers? And secondly, more importantly, while you're talking of we are on the cusp of it, how strong this improvement could be? Can we start seeing a 30 plus DPD reducing from say 3Q onwards? Those are my two questions. Probably I'll come back in the queue for other questions.
So I'll start with the second question. I think, as I said in the first one, we want to stabilize one more quarter from each DPD bucket's perspective. So we are not here to say that reversal will start happen in this quarter. We wanted to stabilize in this quarter, and we will see the reversals happening to the extent possible in Q4. That is our plan of action as we move forward. On this, we are putting in collections effort and a legal recovery team. As I mentioned in last call also, a good chunk of legal recovery team has been put in place where they are starting to yield good results. That is why you see whenever a NPA gets closed, you get a lot of arrears coming back to us. That is where you see the collection efficiency has gone up. So the legal recovery team is doing extremely good work, and you see a lot of reversals happening going forward. On the first question on the disbursement side, I think the levels that what we have increased from a supervisory perspective is giving us a good result. Just to share some data, in Q1 we had a 25% rejection ratio, whereas in Q2 we had a 41% rejection ratio compared to login files getting in. So that is how I measure the strength of layers that we have put in from a quality files perspective is showing a good results from the system perspective. But as I said, 5,000 people of sourcing and 1,000 branch managers of sourcing attuned to this system is new for them. So it will take some more time and some more months to get attuned. So this quarter we will see better disbursement comparing to Q2 and a stronger disbursement coming in Q4.
Got it, sir.
So
Thank you very much. Sorry.
No, Viral, I think Mr. Pati has clearly articulated the changes that we have done. One other thing that we have been highlighting to you even in the past also is the slight shift in focus on customer profile. So while the branches have been a little more attuned towards focusing on sub 5 lakhs ticket size, today we are moving the focus slightly towards the 3 to 5 lakhs and 5 to 10 lakhs. So that also takes a little bit of time. So the changes that we actually made is in terms of going behind the right customers and ensuring that these are underwritten in a stronger manner by stronger people. So we have added more layers in terms of doing the underwriting checks, which has caused a little bit of an impact in this quarter. But I would say that most of that have been ironed out. If you look at September standalone, the numbers have been very good. In fact, we have crossed more than 500 crores of disbursements in the month of September. We should start seeing good run rate coming in Q3 and Q4.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah. Good evening. So thank you for taking my question. So the first one is, if you could give some geographic color around what is it that we have seen during this quarter, which are those geographies where we have seen NPAs inch up, and likewise, given that we are expecting Q3 to be a quarter of stabilization and improvement from Q2 onwards, which are those geographies in particular which will contribute to that? The second question, sir, that I had was on the guidance front. Now that we are looking at Q3 stabilizing, it's much stronger improvement from Q4 onwards. How is it that you are looking at the remainder of this year in terms of growth, in terms of credit costs, as well as if you could speak a little bit on FY27 in terms of guidance? And lastly, sir, while I acknowledge that both the MFI and the micro lab product that we do are very different, for at least the last couple of quarters, right, at least in MFI business, we have seen the goalpost has just kept moving after every quarter. In other words, what I mean is we are still seeing some of the NBFC MFIs increasing their credit cost guidance for the coming quarters and the next full year. So how would you look at that, given that in the past we have acknowledged that we also have maybe 40-45% of the customers where there's an overlap of microfinance loans? So just those couple of questions, if you could take me with that. Thank you so much.
So Abhijit, the first point, you're talking about the geographic color. Like we said, I think we have seen a good amount of stabilization across the various geographies. So there is no specific geography where we can point out a more than normalized improvement or a more than normalized worsening. The one geography which continues to be a little bit of a concern is Karnataka, where the numbers are still a little higher. But given that our portfolio in Karnataka is only about 5 to 6%, this is not going to have a very significant impact on our overall AUM. But otherwise, we have seen improvements even in the other bit of a problematic geography that we had, which is Andhra Pradesh. Even there, we have seen some bit of improvement happening in this quarter. So largely, the 18 basis points increase in NPA has been, I would say, uniformly contributed across the geographies. There is no specific geography which has seen significant improvement or significant worsening, which is also giving us a good hope and belief that overall, at a macro level, also things are getting settled in. And from here onwards, we should start seeing things improving. So there's no specific concern on any geography at this point of time. The concern, again, is on the ticket size. So if you look at across our portfolio, where we see higher delinquencies or higher NPAs is still in the sub 3 lakhs ticket size. So if there is a geography with a little more pronounced proportion of sub 3 lakhs, that geography is probably showing up a little bit of a higher number in terms of delinquencies and NPAs. Otherwise, we are not seeing any geographical differences in any of the states. Coming to your question on guidance, Abhijit, at this point of time, we would like to say that whatever guidance we have given you in the past, we are not changing the goalpost at this point of time. We still hope and believe that we should be able to deliver on our guidance. Mr. Pati also talked about this in his opening remarks. We still believe that we should be able to deliver on the guidance that we have given you. So at this point of time, there is no change in guidance either on growth, profitability, or asset quality or credit cost. Sorry, could you please remind on the third question?
So the third question was around this micro lab and MFI, where I acknowledge that while both products are very different. So if you could elaborate.
Yeah, Abhijit, this is a point that we have anyway clearly told you. While there is an overlap from an MFI borrower perspective, the behavior of the borrower is very different when it comes to different products. So while the borrower definitely tries or is hopeful that he may be able to get benefits from a secure LAP lender also similar. Abhijit, is that your line where we are seeing quite a bit of disturbance?
Yes, I was on mute.
Okay.
Yeah, now it's okay.
Yeah. Sorry. Yeah. So what we are saying is, while there is an overlap and we saw a temporary issue because there was a little bit of a behavioral issue from the borrower side when they saw that microfinance had written off their loans, the collection efforts had reduced, and there was a hope that secured lenders also will follow that path. But when they see secured lenders coming to them, following up, more frequently, taking necessary legal actions, the behavior definitely changes, and that is what we are seeing in this quarter. While it is still happening in a very gradual manner, we still believe that just because a borrower has taken a microfinance loan, which could have been, written off, while his belief might be there, the question is, depending on the actions that the lender takes, the borrower's behavior will also shift. So we are still confident that even those borrowers who slipped in Q1, we will be able to collect the entire money back from them. But the question is, you may not be able to do it through, let's say, a regularization kind of a route, like collecting multiple installments from them. But you need to bring them back towards the behavior of paying one installment every month. And then it's just a question of maybe 1 or 2 months extension in tenor, by which time they will pay up their entire loan. So we don't really see any impact in our eventual losses or in our eventual ability to recover from these borrowers.
Got it, sir. This is useful. I just wanted to squeeze in one follow-up question. While you said that there is no change in guidance, just wanted to understand from next fiscal year onwards, what should be the steady state credit costs now?
Vijit, we have told you in the last call itself, the credit cost guidance change, what we said in last call from 0.75 to now it's 1.25 to 1.35 range. We'll hold it for a shorter period of time, right? I don't think next year we are going to change the guidance on credit costs. This product, this customer needs this kind of credit cost. It's what that we have concluded, and we have told that guidance. This will hold on for at least next 18-24 months.
Got it, sir. Thank you so much, and I wish your team the very best. That's it, sir.
Yeah, thank you.
Thank you. The next question is from the line of Raghav from Ambit Capital. Please go ahead.
Hey, hi. Thanks for the opportunity. I just have two questions. One, your business officer count is up some 35% versus last year. Obviously, the focus has been mostly on collections. But when you decide to press for growth, will you continue to hire with the same intensity, or will it be lower? Because even the current the capacity that you are creating can be utilized, for growth. So I just wanted to understand what are your thoughts on this.
Yeah. Yes, Raghav, you're right on that. Building the infrastructure should not stop unless until your business runway looks very dull. But our business runway looks very bright, because today the biggest opportunity is small business loans and small secured loans. So we are continuously creating the infrastructure, and if we see the stabilization continuing and no more damages happening to the repayments, I think then the business pedal has to be moved up. So that is what we are expecting in Q3 little bit and Q4 more strongly.
Understood.
So Raghav,
thank you.
Just giving you a breakup, the 700 odd officers that Mr. Pati alluded to in his thing, that also has collection officers. So it's almost like 500 business officers and about 200 collection officers. So we are strengthening both sides of the of the operations, such that we have the necessary infrastructure when we want to press the pedal of growth. At the same time, we are building a good collection support to ensure that there is no slippages.
Understood. And the stability in collection, unique collections that we have seen in Q2 over Q1 is a result of that. Is that understanding correct? Because of the investments that you've done in hiring collection officers over the last 1 year?
That's right, Raghav.
Understood. And one more related question is that, you said that 1.25, 1.3% is something that should be a steady state number on credit cost. Does that translate into, say, 4.5 to 5% kind of static NPAs, right? If we were to look at NPAs on a static pool, does it translate into that kind of a number, around 4.5, 5%? I'm just asking for my modeling purposes.
So Raghav, we'll take it offline. We've not really looked at that. The number seems a little high, what you're talking about, but obviously then on a static pool, whatever we used to guide about 3.5% on a static pool will go up. But I'm not sure if it will go all the way up to 5% and all that. Let's take it offline.
Sure. Just last question. The write-offs were quite high this quarter. How much more do you expect to write off in the second half? And, how should one think about the stage 3 coverage? Will you take it back to 50% over time?
See, this write-off, the way you should look at Raghav is, it is done for the first half of the year. So while we have done it in one quarter, but it's for the first half of the year. So we are talking about, let's say, a 50 crores write-off that we have done. So it's, broadly, I would say 25. But then the next 2 quarters, the write-off will be a little higher because we would want, the financials allow that, and we would want to take benefit of technical write-offs. So the write-offs will be a little elevated compared to the run rate that you saw in the first half of the year. So maybe from your modeling perspective, you need to bake in a little higher write-offs for the rest of the year. And from a provision coverage perspective, see, as we take more write-offs, mathematically the coverage will come down. The current regulatory climate is also that they are not really pushing for any specified coverage number on stage 3. So it will largely be guided by our ECL model and our LGDs, which probably should be somewhere around the 40 to 45% kind of a range. So, it is not like we are working with a specified number in mind. It will be coming out of our ECL model. At this point, we don't envisage taking it back to 50% just from a number perspective. But if the model throws 50%, let us say for whatever reason at a later point of time, that's the number it will be. If the model throws, let's say 42%, it will be 42%.
Understood. How much write-offs can we build for second half?
Are there any numbers? Why don't we just take it offline?
Sure. Yeah. Fair enough. Thank you.
Thank you. The next question is on the line of Amit Khetan from Laburnum Capital. Please go ahead.
Hi, thanks for taking my question. So my first question is on OPEX. So if I look at the last couple of years, right, our OPEX to total assets, average assets has been in the 5 to 5.5% range. Now, that was a fairly benign credit environment. Going forward, as you're guiding to higher credit cost as well as, beefing up the collection and legal recovery team, how do you expect this ratio to evolve on a steady state basis?
So Amit, this is again something that we've been talking in the past also. So generally, at least for the short to medium term, the guidance continues to stand at about 5 to 5.5%. While we will definitely get some benefit of scale, we will also be upfronting certain investments, in terms of collection support, in terms of technological investments and all that, which will continue to keep the OPEX a little elevated than where we would like to be. So I think you should build in about 5 to 5.5% of OPEX for the short to medium term.
Understood. Second question was on the housing product. Can you throw some more color in terms of what is the customer profile you're targeting? What are the yields, ticket size, and geographies that you're currently looking at?
So, see, housing product has actually been introduced in some of the safest and the strongest branches of the company. So, in about 175 to 200 branches. We are expecting to lend to the same profile of customers, slightly, maybe people whose expectations are a little higher, average ticket size of about 6 to 8 lakhs. Because these are people whose expectations are higher, but maybe the incomes from a LAP tenure perspective don't match up. But given that they are going to be using this money for housing, we are expecting an yield somewhere around 16 to 18% and lending for up to 15 years or so, or maybe beyond that, depending on the requirement of the customer, which will make the customer qualify for, let's say, a 7-8 lakhs kind of a loan. So that's the profile and the product characteristics that we are targeting.
Got it. And you intend to apply for a separate housing license, or how should we think about that?
Currently, not now. I think there is an echo coming back.
Got it. But we would be disadvantaged, right? Because of the we can't access NHB housing finance.
I think Srikanth has told you from a debt perspective and the pricing perspective, Five-Star is very attractive, and we are able to get the current debt at around 8%. And for the housing, which is a priority sector, we may even target lesser than that percentage, which will argue well for us. So debt and pricing will not be a problem.
Got it. Thank you and all the best.
Thank you.
The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah, thanks for taking the question. So, firstly, when we look at in terms of the number of people, maybe on a quarter-on-quarter basis, there's almost like 1,000 which has got added, particularly in the business and collections. And that too, I would say like maybe more on the business side. So is it with the confidence with respect to preparing ourselves for the growth? Is that the right observation?
Yes, Kunal, you're right. Close to 800 officers have been recruited in last quarter. Out of that, if you see, 600 has gone to business and 200 has gone to collections. A rough figure, right? So this clearly indicates the focus is back on business. When the collection gets stabilized, as I've been saying in the call, you see the pedal pressing for the business, which will happen in Q3 and Q4. Yes, we are preparing for a good business.
Got it. And secondly, on account side, is there some rejigging which has happened, or maybe have they been moved to some other place? Because almost like 180, 190 people moving out of accounts. So is it something like maybe they are getting towards the business side of it? Has there been any rejigging?
No. So Kunal, what we have done is you would see that number a little more at the operations side. So earlier we used to have an operations officer and cashier. So the number, if you see the drop, will be in the cashier side. So we used to have a cashier and an operations officer in a particular branch. Given that the cash proportion has significantly dropped and the newer branches, the digital adoption has been extremely high. What we are now doing is we are only having one person, so not having two persons for cashier and operations officer separately. We are having a branch support officer. So those have been mapped under operations. So none of the accounts or cashiers people have actually moved to business and all that. They'll be doing both cash receipting in the branches and also doing the operational support for the branches by acting as a branch support officer.
Okay, got it. Almost like 190 of cashiers coming off and operations officer going up by almost 150 or so.
That's right. Yeah, that's right, Kunal. As you see in our presentation, our digital penetration is moving up from 81% to 82%. Slowly, gradually, we intend to take it to 85%. So the work of cashiers is going to come down as we go forward. So we are deploying them in the operational work.
Perfect. Got it. Thank you. Thanks a lot. Yeah.
Thank you.
Thank you. The next question is from the line of Ajit Kumar from GM Financial. Please go ahead.
Yeah, thanks for the opportunity. Just 2 to 3 questions from my side. First, coming to FY26 AUM growth guidance again, which is roughly 25% versus 18% growth currently. Our rate in terms of disbursements become very steep. Almost around 1,800 to 1,900 crores of disbursement per quarter is needed in next 2 quarters versus 1,200 to 1,300 crores of disbursement that we are doing currently from last 8 to 9 quarters. Do you think this kind of acceleration in disbursement in second half is possible?
Ajit, if you look at disbursements in Q4 of last year, we were almost at about 1,400 to 1,500 crores of disbursements. So if not for the issues that we probably faced in Q1 and some consequent changes that we have done because of that, we would have been disbursing more around, let's say, a 1,500, 1,600 kind of a disbursal run rate in the first half of the year. So to move towards, let's say, 1,600 to 1,800 is not difficult in the second half of the year. Obviously, the company will keep the the necessary caution in mind before stepping up the disbursals. But our point is, it is not something that is not doable. We have done it in the past, and based on our run rate, we should be able to do that. So it's not an unachievable number, but we'll definitely keep various aspects in mind before pushing the pedal of disbursal. At this point of time, we are not revisiting our guidance on our growth.
Sure. And on credit cost, just wanted to confirm again, FY26 guidance is 1.25 to 1.35%, right, as you highlighted just now. Because in last quarter call, credit cost guidance was 1.2 to 1.25. So just wanted to reconfirm credit cost guidance for FY26.
No, so Ajit, even last quarter we said 1.25 to 1.3, 1.35 only. So the guidance stands. So we have not changed our credit cost guidance. It will be about around 1.25 to 1.3%.
And this is as a percentage of AUM, right? Not as a percentage of assets.
No. This is as a percentage of total assets. When you compute on AUM, this number will be more around 1.5 to 1.6%.
Okay. And just last one, AUM growth in Tamil Nadu has been lagging from last few quarters and has come down to only 10% odd in this quarter. Any issue in Tamil Nadu in terms of growth or asset quality as it is your home state?
No, nothing. Tamil Nadu is gearing up very well, and the collections also is very good. So you see a good amount of rundown is also happening in Tamil Nadu when the collections are stacking up very well. So I don't see anything coming up, and you see improvement in this in next 6 months also. So slowly that the state will move towards 30% of our overall AUM.
Okay. Sure. Thanks. That's it from my side.
Thank you.
Thank you. The next question is from the line of Chandrasekhar from Fidelity. Please go ahead.
Hi. Good afternoon. So the yield drop since you've instituted the disbursement cut has almost been 100 bits on the book. Now, typically in one particular year, you have about 40-45% is that which has been originated in that year. Now, this year, obviously, a lesser portion has been originated because disbursements have been slower. So how could there be a 100 bits drop in book yields when only 35% has been originated during that year? Have you all done some differential pricing of some people even below 22% yields?
No, Chandra. This is a little bit of a function of the delinquencies as well. If you look at accounting methodology or interest accrual methodology, that follows an ideal schedule. Whereas as per the Indian accounting standards, the unpaid interest gets added back to the principal. So let us say if a customer does not pay, you are accruing or you are charging a penal interest which does not get accrued on books. But what happens is the interest as per the original schedule is the one which is in the numerator, while the denominator, the interest also gets added. So whenever there is a little bit of a delinquency that gets built up on the portfolio, you will see a little bit of yield drop. If you want to look at the overall number, you should probably add the penal interest to this and compute the yields. But even that will be slightly lower because generally the collections itself has been a little muted, right? So it's a function of accounting rather than any further drops that we have done.
Understood. But there's been no change. I mean, otherwise you're broadly at that.
At about 22%, yeah, 22, 22.5.
Understood. Then just, employee cost growth has been 15%, but the count is up actually 25%. So, what's happening here? How is there such a substantial difference? That's the second one.
Well, a lot of the growth has actually come in towards the end of the second quarter. Because collections, we were putting people, but when we saw that things are stabilizing, like Mr. Pati said, the business officers have been added more towards the end of the quarter. So you're not seeing their costs fully absorbed it. So that is why I would say, don't look at an OpEx of 5.07 as compared to 5.47 on a sequential basis. This is, you should probably build somewhere between 5 to 5.5% for the full year. 5.1 is not the indicative number that you'll probably see for the full year.
And the last question is obviously you saying that the recovery legal teams are able to recover from the assets better. My understanding of this business is that the threat of recovery works more than the actual recovery. It's very tough to actually recover. And given the ticket sizes, you can't even use surfaces. So is there been some change that you're able to recover more now than in the past?
Yeah, Chandra, I think I've been articulating these things since beginning. This is a myth that you people think that smaller ticket size loans, properties cannot be sold or brought in for action. That was a conscious decision that company has taken for last 20 years not to go into auction route, rather than negotiate with the customer and collect your dues. That is how we contained our NPA. But having said that, in last 2 years, since listing, we started to focus on bringing the properties of NPA customers to auction and taking them to the legal proceedings. So we have put in a chief legal officer 24 months down the line. And today we have close to 150 legal people who are working on legal recovery. So that is why I said in last conference call also, earnings call also, close to 75 to 80 crores of NPA will be recovered for the full year. Just to give you the number, last quarter, July, August, September, close to 20 crores of NPA got resolved in a single quarter. So that again shows, even though small ticket size, the properties are genuine, the documents, legal documents are very clear, and buyers are there, so that we are able to recover close to 20 crores of resolutions happening from deep delinquent NPA accounts. And this will continue.
Thank you.
Thank you. The next question is from the line of Arvind Ravichandran from Sundaram Alternates. Please go ahead.
Hello team, thank you so much for the opportunity and congratulations on the good set of numbers despite a tough environment.
Sorry to interrupt.
Yeah.
So you're quite low. Could you please keep the mic towards yourself and have a louder tone?
Yeah, is this better?
Yeah, that's better.
Yeah, better, please.
Yeah. So I just want some clarification in terms of credit cost guidance. We mentioned 125 to 135 bits. Is it on total AUM or on average AUM or like an average total? It's balance sheet assets.
Arvind, it's average balance sheet assets, total assets.
Oh, okay. Because generally in market, we talk about when we say credit cost, it's usually on average AUM. So that's why there was that's how. So okay. So if we can make clarity on if it is an average advances or average AUM, it would be better, so that everyone would have a clear idea of what we are referring to. That is my request. And
Arvind, we'll take a look. Generally, we have all our ratios on total assets, so we don't want to think this as a separate number. But sure, we can give you a guidance depending on how the trend was in the past in terms of how it will look on an average AUM. But we can take it separately.
Yeah. And I would like to understand the new housing loan which we are introducing. How are we looking to scale it up? Is it are we looking to make it a 5 or 10% something like that over next few years? How are we looking to scale up as a percentage of the overall AUM over next few years? If you can give some color on that.
It's a little early to speak about going forward. But now, as we have introduced in October month, we have picked up close to 125 to 150 safe locations of 5-star across India, and we have introduced only for those branches. So the logins are coming in, the processing is going up. Maybe in this financial year, we may build up close to 150 crores of housing, pure housing loan portfolio, translates to 1.5% of our AUM. Going forward, let me give you a good color after 6 months of being in this product, maybe after the March quarter.
Okay. Also, can you just share, what was the actual write-offs in this quarter?
It's about 49 crores, Arvind.
Okay. Yes, thank you. If I have any more questions, I will just come back. Okay. Thank you.
Thank you.
Thank you. The next question is on the line of Rehan Syed from Trinetra Asset Managers. Please go ahead.
Hello, good afternoon, and thank you for giving me the opportunity. Just I wanted to confirm that my all questions have been answered. So, could you please give me the economics of new branches that you have added in FY23 and 26 for specifically time to break even and productivity curve related to earlier vintage?
So, Rehan, this is similar to what we have been doing in the past also. So every branch typically takes anywhere between 6 to 9 months for achieving a complete break-even. Because they are able to log in, we start with about 5 officers, and each officer logs in about 4 odd files, out of which 3 get converted. So which means it's about 15 files that gets logged in on a monthly basis, which will roughly work out anywhere to about 50 to 60 lakhs. And then when the portfolio reaches about 2.5 to 3 crores, we are able to break even. There are branches which do this in 6 months. There are branches which do this in 9 months. So if you look at it, I think historically we have seen that almost 98% of our branches reach this break-even between 6 to 9 months. There could be some very few outlier branches. Nothing has changed for the newer branches also.
Okay, fair enough, and thank you for the clarification, and good luck for your coming quarter.
Thank you. The next question is from the line of Sanjay Ladha from Bastion Research. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. Sir, I just wanted to know that, we are focusing on housing ticket size loan book. And, what we have observed and listening to various other players, most of the players are entering into, this secured segment. So my two questions, how you see competition in that space? And most importantly, are you seeing NIM will maintain at this level given the competition will engage? And of course, you already has highlighted that this will going to drop down going forward as you start taking leverages on that side. But if you can highlight more onto that, where we see the stabilization taking place. Hello.